still hear it? Are we shooting?
No.
Oh, we're rolling? Cool. You guys are good? We're good? I'm good? You guys are good? You good? You good? Everybody good? Here we go. What am I on? We're episode 23. Okay, cool. Hey everybody, what's going on? My name is Arman Vakili, and this is episode 23, the Michael Jordan episode of Hashtag Everything Money, the show where we talk about everything that has to do with money. And so today's episode is actually, we're kind of gonna go back to the basics a little bit. The last few episodes were pretty advanced stuff, like we did talk about a lot of crazy details. And this is actually a question that was brought up by somebody that watches us live on Periscope as we shoot these episodes. And it was something in regards to their lending portfolio or their lending profile or their credit. I'm just messing up with all my words. Or their credit profile. And essentially, it's a question that a lot of people have when they're trying to go borrow money or get some kind of a credit product, whether it's a credit card, line of credit, personal loan, business loan, home equity line of credit, mortgage, auto finance, anything. And so there are certain things that financial institutions typically look at when they're trying to qualify you for a loan. Now let me backtrack a little bit. Prior to 2007, 2008, there was something called a stated income loan, meaning that you walk into my bank, and so this was actually happening when I was still in banking, because I left banking in early 2007, right before that crash, okay? So you walk into the bank, actually I left, what am I saying? I left right after the crash. And it was, I saw that like the drastic difference between what the qualification methods were for people who were trying to get a loan, right? And so prior to the crash in 2007, you walk into the bank and you say, hey, my name is Joe Schmo and I make $500,000 a year and I want a loan for $2 million. And so we say, hey, you're probably right. And so what we're gonna do is we're just gonna take it based on what you're stating, right? That's what a stated income means. There was no verification, there was no looking at people's W-2s, there was no looking at people's 1099s, there was no looking at people's tax records, bank statements, none of that stuff. The guy says he's making $500,000, he must be telling the truth, so let's give him a loan for $2 million. Now this was agreed on both sides because the client, the customer, saw some infomercial on TV saying, hey, this is what I'm doing in real estate and I'm making billions of dollars, borrowing money from the bank and doing this without any money out of my own pocket, blah, 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 blah. And so then at that point, everybody said, hey, I'm gonna go do this, right? I'm gonna go get these free loans pretty much from the bank and I'm gonna use it to buy a property and then I'm gonna flip the property and overnight I'll become a millionaire, right? So all these infomercials were going out and people by the thousands were going into banks and borrowing money that they could not afford to pay back. And it was all based on this whole idea of, hey, we're gonna get it, we're gonna buy the house and we're gonna flip it. We're gonna get it, we're gonna buy the house and we're gonna flip it. Now the issue with this is when everybody starts doing it and everybody starts borrowing money and everybody starts buying these houses and then relisting them back on the market, the problem is there's nobody else to buy these houses because everybody went and borrowed money to actually go ahead and buy the house. And so everybody's working with borrowed money. There's nobody that actually has cash or money to actually buy these houses that have been marked up. And so eventually it got to the point that the guy who only makes $50,000, he doesn't make $500,000 because he was bullshitting. And so the guy who lied on his income statement saying that I make this much money now is left with payments on a $2 million loan. And you can't make those payments with a $50,000 salary or $50,000 income. And so what happens? Bank after bank after bank after bank. Foreclosures, bankruptcies, foreclosures, bankruptcies. And 2007 happened. One of the most epic crashes of the last century happened less than 10 years ago because there was stated income loans, right? And so just let me pause right here so I can address the question right here. I'm not talking about the housing bubble. The housing bubble has something to do with what I'm talking about, but I'm mainly talking about what banks and financial institutions are considering right now when they consider your lending portfolio and your credit portfolio and whether or not they want to lend you money, right? So prior to 2007, it was all based on stated income. They didn't look into anything right now. Or they didn't really look into anything about your actual financial portfolio, right? Right now, back to you guys, back to YouTube, right? And Facebook. Right now, what's happening is that it's kind of the extreme polar opposite of what was happening prior to 2007. Right now, your credit score needs to be in shape, your debt to income ratio needs to be in shape, you need to have liquid assets in place. You basically need to be somebody that doesn't need the loan. And so if you are somebody that doesn't need the loan, most likely you're gonna end up getting the loan. And that's what banks are looking at right now. And so let's talk a little bit about all of these different things. So your credit score is pretty simple. Everybody knows what their credit score is. You may not know what your actual number is, but you know what a credit score is. You know that, hey, if I make my credit card payments on time, if I make my phone bill payments on time, if I make my car bill payments on time or my car payments on time, then I'm gonna most likely have a pretty good credit score because my credit history has been pretty consistent, right? I paid on time. Now, a good credit score is no longer just enough. Like just having a good credit score is no longer enough to get a really decent loan or like a pretty heavy duty loan. Because the second thing that they're looking at is your debt to income ratio, which means what? If your income on a monthly basis is $5,000, let's do 10,000 because it's just easier to do round numbers. If your income on a monthly basis is $10,000 a month and your debt obligations between your mortgage, car payment, credit card payments, lines of credit, loans, anything, your debt obligations is $5,000 a month, that would be a 50% debt to income ratio, right? The magic number is 35% or below. So it doesn't matter which institution you go to, typically they don't want you to be higher than 35%. And even 35% is cutting it close, right? So let's say you're at 35%, $10,000 a month, 35% of it is $3,500 a month. $3,500 a month is your debt obligations, your debt payment obligations. At that point, what they're gonna look at is your net assets, your liquid assets. What do you have in place that if something happened, you lost your income, you lost your current cash flow, you lost your everything, right? How am I gonna get my money back? How, as a bank, I'm looking at you and thinking about this. How am I gonna get my money back? If you lose your job and if you lose your source of cash flow, how are you going to make these payments? And these are the things that they're really like very, very serious about. And if you have a house, you can collateralize the house. If you don't have a house, you're kind of SOL. If you have like a decent car, you may be able to collateralize the car. And it all depends on the loan too, right? And depends on the size of the loan, the interest rate of the loan. There are so many things that come into play. There are so many variables that come into play. But there are these standard guidelines that they're going to look at. Does not matter what you apply for. The credit score is the least of your worries. They want to know how much money you have actually saved up. They want to know what your debt to income ratio is. And they want to know how qualified of a borrower are you? And how responsible of a borrower are you? And these are things that every institution. Now, watch this, okay? There are companies, because I've heard this happening, especially a lot more recently, that there have been companies that started doing the stated income loans again. And I mean, if history is any indicator, I have a very strong feeling that they're gonna go out of business. I mean, it's so easy to take advantage of an institution and just lie your ass off when there's nothing being verified, when they're not looking at income statements, they're not looking at tax statements, they're not looking at bank statements, and they're just handing out loans. Like, there's something wrong with that. And I was weary of it. I was like very concerned about it prior to the crash happening in 2007. So the fact that the crash happened and people are still doing it, it's like really concerning, right? So all of that being said, to say what? If you're the consumer, I mean, you probably are the consumer. Either you're the business owner or you're the actual family head of household that you're trying to go to an institution and you're actually trying to you're borrowing money. My recommendation to you is this: same rules that they look at, or the same rules that the banks have for qualifying you, I think should be the same rules that you use to qualify yourself. Meaning what? If you don't have enough money, liquid, saved up to actually go either put like a really heavy down payment on the major purchase that you're trying to make, or buy the whole thing in cash. Like if you don't have that kind of money saved up, you probably shouldn't be doing a loan. Put yourself in a situation that I have the money to pay for it in cash, I just don't want to use my money. I want to use the bank's money. And then I'm going to use that. And then there's an episode that we have on leveraging debt, and I have no idea which episode. I think it was episode 5. Either episode 5 or 6. I'm going to put it up here, episode 5 or 6. It's already up on YouTube, and Deji's going to do like the episode right here in the editing. But episode 5 or 6 talks about leveraging debt to actually make more money, and leveraging debt to actually flip money and use the bank's borrowed money instead of your own cash to actually go make these major purchases and then make money on the debt and then pay the debt back with the interest, so you're completely debt free and now you have an asset on the side. So we actually talk about that in pretty fair detail in episode 5 or 6. I can't remember. I just know that there was an episode. It's either 5 or 6 that talks about leveraging debt. So that's there for you. So definitely reference back to that episode to actually watch how you can leverage the debt, and then put yourself in a situation that you're not using debt to make purchases that are superficial, that are not beneficial to the family, but you're using debt to actually make more money. And that's I was gonna say it's a subtle difference in thought processes, but I feel like it's a very, very substantial difference in thought processes and philosophies general. So that was episode 23, which is the debt to income ratio episode and the debt qualifications, credit qualifications episode. Now we do have debt professionals, licensed debt professionals that just can help you with the consult if you actually need one. If you're currently in a pretty heavy debt situation that you want to get out of, we can help you do that, whether you're trying to consolidate, whether you're trying to settle, or maybe even considering bankruptcy. Although I recommend bankruptcy as like the absolute last resort. But if that's something that you're considering, talk to us and let us kind of help you walk through it. Let us talk you through it and see if there's any way that there are other options for you other than filing for bankruptcy and putting something on your record for the next 7 years minimum. So that's that for you. And then on the other side of it, if you want to actually learn how you can leverage debt to make more money, so you're not necessarily in a lot of debt, but you want to learn how to leverage debt to make more money, also give us a call. Well, actually, I don't think we're going to put up the phone number. We're just going to put up an information capture form that you can register to speak with somebody, and then they'll go ahead and call you in the next 24 hours. So that's how we're going to end up doing the debt side of things. I hope you found value in this episode. I hope you're subscribing to the channel. If you're not already subscribing to the channel, look, where is it going to be? It's going to be right here. The subscribe button is going to be right here, right under the video. Subscribe to the channel. It's free. We're not asking for money. We're not asking for anything. I'm trying to give as much value to you as possible. And all I want in return is a subscription. That's all I want. And then of course, I want you to share it also. I want you to like also. I want you to go and tell every single person that you know about it also. I want you to leave comments in the comment section. I want you to leave questions in the comment section so that I can go ahead and answer your questions in the future videos. This question was brought up actually by one of our followers. Unfortunately, I didn't get the username or website to be able to give them a shout out, but I feel like it was a good question for me to be able to answer for you guys. So that was episode Michael Jordan, episode 23 of the Hashtag Everything Money Show. My name is Arman Vakili. As soon as this ends, there's going to be all my social media profiles. Follow me. Let's talk. Let's mingle. And let's chop it up. Let's see what we can do for each other. And hopefully we can mutually benefit each other. And one more time, Arman Vakili, Hashtag Everything Money, episode 23. And I'll see you in the next one.